RCA is a data and analytics business. So we're founded in the US in 2000, and our goal is to track the real estate investment and financing market all around the world. So anywhere a deal happens, anywhere an investment transaction happens, anywhere a financing happens, we try and track that, and it goes into our database. So we've got offices in New York, London, Amsterdam, Vienna, Singapore, and we're just opening one in Sydney as well for a new Australian service. So we've got a true global footprint, I should say. And my role is Senior Director for the EMEA analytics team. So I look at all the information that comes out of our database and try to make sense of it and communicate it to our clients. First slide, and this is all European data broadly. Everything's taken from our transactions database with the exception of the COVID-19 data, obviously. So this is a chart that shows deal flow into our system in 2020, which is the orange line, versus 2019, which is the dotted orange line, versus the COVID case count across Europe. So what can we say? Well, very clearly, you saw a drop off in deal flow around the end of March, really through that first lockdown period where we saw those two, the dotted orange line and the orange line diverging. And really since then, the market has remained slower than it was last year, which is not a surprise. You know, we've obviously got the shock, the economic shock. You've got the restrictions on movement, which obviously affect a real asset, you know, like real estate, which make it more difficult to do deals. So broadly, the market slowed quite substantially this year. But what I would say is that we did see a pickup in Q4, which is, as you'd expect. There's a high degree of seasonality in the way the market behaves and when deals get done. So Q4 is always the strongest quarter of the year. And we did see that orange line there start to pick up from, I guess, the middle of November onwards, which is interesting because that also coincides with when we saw the case count pick up across Europe. And actually, European countries re-entered lockdowns or tightened restrictions that had been loosened over the summer. So that does go to show, I think, that, you know, having come to a kind of screeching halt in April, May, the market has perhaps found a way to keep transacting and to keep doing business despite the fact that the case count has risen towards the end of the year. And I think it is clearly going to be very interesting. We're still very early in January for our deal volumes, but there's still deals being done in January despite the fact that most of Europe is in some form of lockdown or another. So it seems like real estate investors have found a way to keep doing deals despite the lockdowns. So what does this mean just for investment volumes across Europe when we compare to previous years? And I've just got the actual quarterly numbers on there so you can see, you know, the market had a lot of momentum coming into the first quarter of this year. You can see 77 billion was spent, which is the best Q1 since 2015, but then it slowed very substantially. So the middle 6 months of the year were very slow. And even though we did see that pick up in Q4, 76 billion spent as at today when I updated the slides last, but you can see it's very, you know, it's down quite a lot versus last year, down 44%, which is interesting because actually if you compare Europe to the US, for example, the US market slowed very, very quickly and actually has picked up towards the end of the year, whereas you might say the reverse is true in Europe, certainly if you look on a comparative basis. So where's the capital going? If you just look at the split by countries, you know, I won't dwell too long on this slide, but broadly, most of the top 10 markets have seen a slowing in investment to varying degrees. A few points I would pick out here. Spain, the market has slowed very substantially by more than 50%. And that's actually consistent with the markets in Europe that have tended to be more cross-border oriented. So we've got data that shows that, you know, the greater the dependence on cross-border capital, on average, the greater the slowdown in investment post March, really, which is when all the movement restrictions kicked in, which makes sense, I think, when you think about, you know, how it's affected all our, you know, our everyday lives and how we, you know, investors weren't able to go and see assets. So some deals were done, you know, using, you know, local partners and boots on the ground, but that, you know, on an aggregate level, that's clearly had an effect. Also, a few markets at the bottom that have done well, Norway and Switzerland, both heavily domestic focused, and I think that's a strength given the current conditions. Also, Denmark stands out a little bit. It was a kind of a very slow year last, you know, in 2019 in Denmark, but also the Danish apartment sector has really boomed, and that's attracted a lot of capital. And that feeds into my next slide, which is there's a clear sector-based hierarchy has emerged through the crisis. So this is looking at change in deal count along the horizontal axis, change in deal volume along the vertical axis, all versus 2020 versus 2019. And the size of the bubble is how much was actually spent. But if you sort of scan from bottom left across to top right, you can see it pretty much goes in order of preference, certainly in line with what people are saying. So hotels down in the bottom left, they're having a very tough time. Fewer hotels were traded last year than ever before in Europe. You've got retail and offices in the middle where there's various structural issues perhaps playing into investment decisions. Certainly in the case with retail, I guess offices is something we can discuss because, you know, everyone's got an opinion, I guess, on what's happening with the office. But then as you move top right, you've clearly got the sectors that are very much in favor: apartments, logistics and industrial, student housing, and finally, the only part of the market to actually grow in 2020 was grocery retail. Again, not a surprise, but I think, you know, this is all, I won't dwell on this, but I guess this is food for thought for the panel. You know, a lot of people are talking about how COVID has accelerated some of these trends that we'd already seen in the market. And that's certainly true if you look at some of the pricing indicators. This is our CPPI, it's commercial property price indices. I've just got it for UK here, but you can see very clearly the difference in the kind of the flight path between UK industrial up very strongly over the last few years versus UK retail, where prices have fallen quite substantially. Offices kind of in the middle, and you know, some of that I think, especially in central London, is to do with Brexit and the effect it had on the market. So although we've seen this sector divergence play itself out, it was actually already manifested in some respects in the market prior to the crisis. And then just finally, there's been a lot of talk about distress and how that might feed through and affect markets, and certainly there's capital being raised for that. If we look at the sales out of distress in 2020, they were less than, around 1.2% of the market. So a very small proportion of the market. Say, you know, the total came as a sale out of distress, but actually, if you look to the left-hand side of the chart there, you can see clearly in the last cycle, at the start of the last cycle, during the post-GFC, there was a lag. So you'd expect the distress to lag the triggering event. So actually, distress sales as a proportion of total market activity came through sort of 2011, 2012, 2013. So I think we probably would expect a pickup in distress sales this year, focused on those sectors least in demand and with the most operational struggles, so I guess hotels and retail.